With perilous times come an intense desire to run for safety. Safety means different things to different people though. Some people choose to hold cash, while others put their money into bonds. Why not just invest in quality dividend stocks though, with a history of raising dividends every year for at least 25 consecutive years? Over the coming weeks, we're going to profile as many Dividend Aristocrat stocks as possible. We'll cover their important dividend metrics, get to know the business, and clearly state the most important information you possibly could need. Should I own this dividend stock today? Let's get started today with one of the most iconic dividend stocks of all time. Alright, today we're talking about the Coca-Cola Company. And let's just get this out of the way right now. With respect to the Coke versus Pepsi debate, if you prefer Pepsi, you're dead to me, and you can get out. Okay, let's move on. Alright, the Coca-Cola Company, ticker symbol KO. It's in the consumer staples sector of the economy. And it's been raising its dividend now, wait for it, 60 consecutive years, which makes it not only a dividend champion, but also a dividend aristocrat. Coca-Cola gets its illustrious start way back in May of 1886, where Dr. John Pemberton served the world's first Coca-Cola at the Jacobs Pharmacy in Atlanta, Georgia. Fast forward to today, and it is one of the most iconic and comprehensive beverage companies in the world. When you think of Coca-Cola, you might be thinking of Coke, Diet Coke, and you might even think of Sprite and Fanta. But in reality, it includes so much more. Their traditional trademark brands, their sparkling flavors, including hydration, sports, coffee, and tea, Smartwater, Dasani, Powerade, coffee, milk, orange juice, and more. This truly is a global company with broad sales not only across North America, Latin America, but also Europe, the Middle East, and Africa. In reviewing their annual report, you can see their net operating revenues spread across many different segments, with only 1/3 of sales coming from North America. Coca-Cola primarily operates with independent bottling companies. However, it has the ability for a corporate takeover of specific bottling facilities when it needs to make them more profitable. All right, let's talk about some of the important dividend metrics. Coca-Cola's price per share as of November 15th was $60.73 per share. Furthermore, their dividend growth rate across the past year, 3 years, 5 years, and 10 years was 3.6%, 2.9%, 3.6%, and 5.8%. And while that does do an adequate job of overcoming the long-term historical inflation rates, it does not do an excellent job of battling against the current high inflationary environment we're in. The dividend yield, based on that most recent price of $60.73, is 2.9%. Now this compares to a historical 5-year average rate of 3.18%, meaning that it's not really on sale, it's actually selling at a premium compared to its historical average yield. Let's talk dividend safety, because the very nature of this company being a dividend aristocrat means that on some level, it's a safe dividend stock. But just because you have been raising dividends for 50 or 60 consecutive years does not mean you are immune from market challenges and potentially cutting the dividend in the future. To best address the issue of dividend safety, we look at the payout ratio based on free cash flow. We look at free cash flow as opposed to net income because dividends are paid with cash, not net income. Free cash flow is the best measure because it gets down to the very root of the nature, which is cash flow in and cash flow out of the business. The specific ratio here is dividends paid for the year divided by free cash flow for the year. You'll notice here the 1-year payout ratio, meaning for the year 2021, was 65%, which is very healthy and safe. However, you'll notice that the payout ratio over the trailing 12 months, which encompasses the slowdown we've experienced here in 2022, the payout ratio has been elevated to 76%. Now, I wouldn't necessarily call this a danger zone, especially when you factor in a global company like Coca-Cola. When you see companies that are global, not in the growth phase anymore, they're a company all about maintaining and slowly growing the business. At this stage here, this is not a worrisome factor. If we were to stay elevated at 76, 80, 85% for multiple years, that would cause me some concern. But it's normal to see businesses have to stretch a little bit when economical concerns are high. We're here on the Morningstar website, which does a great job of showing historical free cash flow per share. We can see that since 2012, we have very stable free cash flow. 172, 179, 185, 194, 147, 141, 129, up to 190, 169, back up to 270 and down to 235. Your very stable free cash flow. So let's talk about one of the methods we have available to increase cash flow out of this type of investment. Because the reality is 2.9% dividend yield It's not horrible, but it's not great either. You'll notice here that Coca-Cola does offer weekly options. All right, this is the option chain for Coca-Cola Company. Price per share at the time this was pulled, $62.08 per share. Let's go out to 32 days here, which is the best we can do. We can go 25 or 32 out to December 23rd of 2022. We've got our at the money right here. We could go out to $64 right here, and we could capture about $38 for this option for 30 days. One thing you should always remember when it comes to selling options and covered calls, there's no guarantee on option premium, and we are a little bit elevated right now. So there's no guarantee that what we could capture right now today is something we could capture for an entire year, but we're gonna make some assumptions. Let's just assume we could capture this $38 right here for a 30-day option, and we could do that on a monthly basis. 0.38 times 12 months, equals $4.56 per share. Plus, we need to add our annual dividend right now. Coca-Cola pays an annual dividend of $1.76 per share. $4.56 plus 1.76 equals $6.32 per share annually. We take this number, we divide it by the current price per share. $6.32 divided by 62.08 equals an annual cash flow yield of approximately 10.18%. That's a lot better than 2.9%, even if we're making some assumptions about the future. But even if we're increasing from 2.9% to 6% or 7%, this is still 2x or 3x our cash flow than we would have gotten if we had just earned dividends. So let's bring this all together here and answer the most important question. Is this the dividend stock that you should buy today? And the answer to that depends on what type of dividend investor you are. Whenever we're talking about investing in dividend paying investments, we always need to be thinking about, is it better for me to own individual dividend stocks or perhaps dividend ETFs, such as my favorite dividend ETF, SCHD. And for full awareness, you can see here that Coca-Cola is in SCHD. It actually makes up a 3.7% stake in this ETF. So if you're a dividend investor that's looking to diversify and wants safety, and you're also not open to selling options, then making the move to buy Coca-Cola might not be the best idea when you have an alternative, which is to own SCHD, which not only has a better dividend yield right now than Coca-Cola, but also has a good dividend growth rate. Now, it doesn't have 60 years of growing dividends like Coca-Cola does, but then again, you get diversification with 100 different companies. So if you are resolved not to utilize options in your portfolio, then it might just be the best solution to go buy a dividend ETF like SCHD rather than invest in Coca-Cola. Besides, you can always invest in Coke by going and buying a Coke, which is my favorite way to invest in Coca-Cola. However, if you're open to selling options, you can really pop that yield up. And when you factor that extra cash flow in with the fact that this is a dividend stock that has paid dividends consecutive and increasing for 60 years now, it's not a bad investment at all. So yes, it's got a mediocre dividend growth rate, and it's got a very stable dividend payout ratio based on free cash flow. So given all of this information, does it make sense for you to own it? Make sure to let me know what you thought. Leave your 2 cents down in the comments below, and let me know what is the next Dividend Aristocrat I should cover. Remember, I respond to all comments that you leave on the day I post a video. That's all I got for you guys in this video. Have a great rest of your day, and thanks for watching.